Ever see the latest S&P 500 flash across the news and wonder what it really means for you and your money? You're not alone. In the next 10 minutes, I'm going to break down everything you need to know about this powerhouse index. What it is, how it works, and how you can use it to build wealth. Stick around, because understanding this is one of the most important first steps you can take as an investor. So, what exactly is the S&P 500? The name stands for Standard & Poor's 500, and it's an index that tracks the performance of about 500 of the largest publicly traded companies in the United States. Think of it as a giant, diversified portfolio holding giants like Apple, Microsoft, and Amazon. It's market capitalization weighted, which is a fancy way of saying the bigger the company, the more influence it has on the index's value. Because these companies represent about 80% of the entire U.S. stock market's value, the S&P 500 is the #1 benchmark for how the American large-cap stock market is doing. The index, as we know it today, was launched way back in 1957. Since then, it's become the go-to report card for the U.S. economy and the stock market. Why does that matter? Because its performance influences everything from global investment decisions to the retirement savings of millions. Financial advisors, huge institutions, and everyday investors all use it to gauge market trends, build investment portfolios, and measure how well their own strategies are performing. It's not just a number on a screen. It's a reflection of our economic health. Now, how does a company get into this exclusive club? It's not just about being one of the 500 biggest. A committee at S&P Dow Jones Indices makes the final call. They look at a bunch of criteria. The company must be based in the U.S., be highly profitable, have a large market value, and have a lot of its shares available for public trading. This human oversight ensures the index truly represents the U.S. economy, not just a list of the largest companies at a single moment. This is different from other indexes that might be purely automated. This selection process is part of what makes the S&P 500 so trusted and representative. When you look inside the S&P 500, you're looking at a cross-section of the U.S. economy. The biggest slices of the pie are sectors like information technology, healthcare, and financials. But here's a crucial point. Because it's market cap weighted, a handful of mega-sized companies at the top can have a massive impact. In recent years, the performance of a few tech and AI giants has often driven a large portion of the index's gains. This concentration is a double-edged sword. It's great when those stocks are soaring, but it also means a downturn in those few names can pull the whole index down. Let's talk about performance. Historically, the S&P 500 has been a powerful engine for growth. Since the 1950s, it has delivered an average annual return of around 10%, though that's before accounting for inflation. But that journey has been anything but a straight line. It has weathered major crises, like the dot-com bust in the early 2000s and the financial crisis of 2008, experiencing deep drops but always recovering and climbing to new heights. This history teaches us a valuable lesson. Volatility is normal, and a long-term perspective is key. Past performance never guarantees future results, but it provides a useful guide. So, where do we stand right now in late 2025? The market has been on a tear, with the S&P 500 hitting new all-time highs. This rally has been fueled by strong company profits, a ton of excitement around artificial intelligence, and hopes that interest rates might come down. But Wall Street analysts are also waving some warning flags. Valuations are high, the index is heavily concentrated in those few mega-cap stocks, and geopolitical tensions could easily stir up volatility. It's a classic mix of optimism and caution. Given all this, why do so many people invest in the S&P 500? First, it's used for benchmarking. Both professional fund managers and individuals use it to measure their own investment returns. Second, and most importantly, for many of us, is passive investing. You can easily buy the entire index through low-cost vehicles like ETFs. Think of products like the SPDRS and P500's ETF, ticker symbol SPY, or Vanguard's 500 Index Fund. These funds give you instant diversification across 500 top companies for a very low fee. Of course, like any investment, the S&P 500 has its strengths and weaknesses. The biggest strengths are its broad diversification, its liquidity, and the huge ecosystem of products built around it. It's easy to buy, sell, and research. On the flip side, the main limitation is that concentration risk we talked about. You're heavily invested in a few top names. It also only covers large-cap U.S. companies, so you're missing out on smaller U.S. stocks and the entire international market. It's a big piece of the puzzle, but not the whole picture. So, how can you, as an individual investor, use this information? First, decide what role the S&P 500 will play in your portfolio. For most people, a low-cost S&P 500 index fund, or ETF, serves as a perfect core holding for their U.S. stock allocation. Second, consider dollar cost averaging. That means investing a fixed amount of money at regular intervals, say every month. This strategy helps smooth out your purchase price over time and reduces the risk of investing a large sum right before a market dip. Also, remember what you're buying. An S&P 500 fund is a bet on the continued success of America's largest corporations. If you're worried about the concentration in big tech, you could consider an equal weight S&P 500 fund, which gives every company the same influence. Or supplement your portfolio with funds that focus on small or mid-cap stocks. And always pay attention to fees. Even a small difference in expense ratios can add up to tens of thousands of dollars over a lifetime of investing. Let's quickly debunk a couple of common myths. First, the S&P 500 is the entire stock market. False. It only represents the large cap segment. To get the whole market, you need to add small and mid-cap stocks. Second, index funds always beat active managers. While it's true that over long periods, most actively managed funds fail to beat the S&P 500 after fees. It's not a universal guarantee. Some skilled managers do outperform, but for most people, the simplicity and low cost of an index fund is a winning formula. To wrap it all up, the S&P 500 is a foundational tool for any investor. It offers a simple, cost-effective way to get diversified exposure to the U.S. stock market. Right now, in late 2025, the index is showing strong momentum, but it's crucial to be aware of the risks, especially high valuations and concentration. The key to success is to have a clear plan, know your goals, understand your risk tolerance, and stay disciplined, especially when the market gets shaky. I hope this breakdown has been helpful. Understanding the S&P 500 is a gift. If you found this useful, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next video. Thanks for watching and happy investing.